All right, good morning, personal finance students. This is your e-learning lesson for Tuesday, April 21st. So, a couple announcements. First, grades. Yesterday, I put some grades in, but the only grades that I put in were late grades. Okay, so there were no new grades besides ones that kids had to email me because they didn't meet the Skyward deadline, and they got late points on that. So, yesterday, April 20th was nothing for you guys. It was just a day for teacher grading and planning. And so I got a ton of late grades for those people that did not believe that the grades, they weren't doing the work or anything like that. So I had an inbox flooded of late grades. So there was no new grades put in besides, hey, Skyward locked me out. I'm doing the homework now. It's late. Can you close the gate? And so I won't put in new grades until next Monday. Will be the next teacher learning grading day. So the other announcement is I know some of you guys did listen yesterday, April 20th. I was on the Dave Ramsey show. I expected to be on much longer. This process has been going on for about 3 weeks. I've had a couple phone interviews from Nashville. They've called me and we went over some pre-interview questions, things they'd like to discuss. And the pre-interview questions consisted of much more material. They wanted me to talk about the things that we do in class, some of the assignments that we've done, some of the cool things that you guys have taken and actually put into practice, which is why I was asking for stories from you guys. And I did have all of that ready to go. And I thought that based off the pre-interview stuff that they were asking me and what they were telling me they wanted me to talk about, expected it to be a much longer interview. They did put me up right against the break, and breaks in radio, paid radio advertising spots. I mean, when you're the segment right before the break, they have it all timed out at certain times. So I did get put up right against the break. Maybe that's why it was a very short talk. But for those of you that didn't see it, let's see. We'll run it back real quick. It is on DaveRamsey.com. If you click on show for April 20th, that was an hour 1. And I was on with Dave, obviously, and this guy, Anthony O'Neill, who is his college guy. So let's watch. It's like 2 minutes. Let's check it out.
If you're working for Anthony. All right, Jason is with us. Oh, Jason is a teacher in Frankfort, Illinois. Hi, Jason. Welcome to the Dave Ramsey Show.
Hi, Dave. Hi, Anthony. Thank you guys for having me on. Letting me talk about some financial literacy.
Hey, man, we appreciate it. We appreciate you teaching our high school curriculum. And tell us about that. How long have you been doing it?
I like to tell people that I've been creating awkward family dinner conversations since 2009 because these kids go home and tell their parents about all the things they're doing wrong, and all you're hearing is the fork clinking on the plate, and the dad's mad, the mom's mad, and yeah, that's it's about 11 years.
Wow, that's very cool. I bet it does. We have heard over the years lots of stories of parents' lives getting transformed because the kid respectfully, not belligerently, took some of the ideas that he was learning or she was learning in class home. And that sounds like that's what you were specialized in.
Oh, absolutely. You know what? It's you get to teach the students in the classroom, but one of the amazing things is when they actually take it home and then they teach their parents. And a lot of times parents don't like to hear the message, but when we bring them home with such facts and knowledge, we change some parents' minds and perspectives on debt and car payments and investing. So it's been amazing, not only for my students, but they're changing their families as well.
Yeah. Very, very cool. All right, Jason, what's your guys' question for the day?
Yeah, so I polled a lot of my students, and one of the ones that comes up the most is they're looking for ideas. My students are starting to believe that you can be a student without student loans. And so we're looking for some ideas on things that they could do to help them cash flow their college education.
Oh, man, that's good. And I like your students saying we can be a student without student loans.
How many students are in your class?
I've got over 200 students this year, so I've got I've got 6 classes worth of personal finance
I
students.
wonder how much student loan debt we can keep from happening right now. Ready, set, go, Anthony.
Maybe we can keep a lot. Here's the number one thing is got to apply for scholarships and grants right now. And here's another thing too is they can actually go to community college. I have to echo that and say that loud. Community college, David's gonna cost you anywhere between $0, depending on the state you're in, up to about $4,000. If you work 20 hours a week, you can start off going that route.
Yeah, absolutely. So there's several things, Jason, that Anthony wrote about in Debt-Free Degree, and that we've been saying around here as well in different ways for some time. He really honed the message in when he did the book.
Yeah.
And but the number one mathematical thing that moves the needle for most people is simply college selection.
That's it.
Simply go to a school you can afford, and you don't need to be shopping on the Bentley lot if you have Chevrolet money
Or Honda money.
or whatever it is. Yeah. So, go to a school you can afford, and the entry point of that is community college, what he was talking about, and then get the scholarships. Don't be afraid to work an extra job, a non-traditional job, by the way. You make more money working for yourself, some kind of side hustle, than you do flopping whoppers. And so that's the thing. So working, picking the right school, getting scholarships, that's the biggest 3 things that move the needle. Hey, Jason, again, we appreciate you teaching, man. God bless you.
You're welcome. God bless you, Dave. All right. So just to bounce off of that piggyback, obviously it was really cool experience. I thought it was going to be about 5-7 minutes, maybe a little bit more interview, and they were going to ask me a bunch of questions. Before I did get on the air with the call screener girl, the executive producer of the show, she told me to pick a question that's more vague. So a lot of you guys sent questions like, I'm going to this school and I've applied for all the scholarships I can. What do I do next? Or, hey, what would your investment advice be? And they wanted, here's my situation. They wanted a blanket vague question. So they kind of changed about 5 minutes before the show. They're like, can you just ask something that's kind of blanket and vague? And I said, well, I can ask about cash flowing college education. I taught my kids that. I know you guys know this, that we did chapter 5 where you choose a school, go to JJC for 2 years, transfer out, try to find a good in-state tuition school, work about 20 hours a week, a part-time job, become a scholarship filler-outer person. We talked about all those things. So I know you guys know that. And so the question was more for the 13 million Americans that were listening to that, because I taught you that. Okay, so that question really didn't come from one single person. It was more for the benefit of the 13 million listeners is where they kind of directed me to ask that question. So either way, it was a very amazing, cool experience. Not too many people can say that they got to speak to 13 million Americans at one time. And I don't know if I'll ever get that opportunity again. So truly could be once in a lifetime experience. It was pretty cool. And I hope you tuned in. If you didn't, you got to listen there. So let's transition. So what I've included today in your downloads is a Venn diagram. Okay. So what I'm going to have you guys do is download this Venn diagram attachment and print it out or whatever. Do it on Word, or you can draw some text boxes in here in Microsoft Word or PowerPoint if you know how to do that. Whatever. Heck, you want to take a sheet of paper and draw 2 circles for today's work? Do it. Okay, that's totally fine. What I want to talk about today is, now that we've kind of covered some investments, and we're going to sharpen those up in a little bit, I want to kind of talk about the similarities and differences between 2 of the big types of investments that you might be tinkering with throwing your money in, and just talk about some of the things that are similar about them and some of the things that are different about them. And so Venn diagram, I don't know if you guys have done any of these since middle school. I don't even know if we do these in high school anymore. Everything on the outside of the circles is characteristics unique to this, and where they intersect are things that they share in common. So I do want to go over a couple of these things right now with you. So we're going to talk about single stocks, like if you bought stock in American Airlines, like Flo, or you bought shares of a mutual fund. Okay, and we're going to talk about you know, kind of what makes those things up. So let's start over here with single stocks. And what I'm gonna have you guys do is, on your circle, let's do 4 bullet points or 4 numbers, okay? And I'm just gonna write stuff in. I want you guys to fill it in as well, okay? Characteristics of a single stock. Let's start with number 1. When you buy stock, you are putting your money in one company. So for number 1, go ahead and write one company. And that should make sense, is it's a single stock. If I were to put my money into American Airlines, Mike Flo, sorry, calling you out a little bit. It's risky, and you do know this, Mike. You're smart. You're reading all these investment books. I love it. And you're not, you know, too worried right now because you're so young and stuff like that. But when you do put your money into single stocks, you're putting all your eggs in one basket. Dave said in that first video, okay? You're breaking the first rule of investing of diversification lowers risk. This is no diversification right here, okay? You're putting all your money into one company, which brings me to number 2. Number 2, go ahead and write high risk. No diversification. That's a big word, man. Give myself enough room. Sorry, I kind of trailed off. Single stocks carry a high degree of risk. Why? Because you're putting all your money in one company. Or say you buy 5 different companies. It's not really diversified. You buy 5 stocks. You buy Nike, Under Armour, Walmart, Johnson & Johnson, and American Airlines. It's still not diversified. Your money's spread out in 20% of places, okay? There's high risk. Remember the risk-return ratio. The greater the risk, the greater the return. The lower the risk, the lower the return. And diversification means to spread around. When you diversify, you lower your risk. When you do single stocks, you put a lot of your money at risk, okay? The third one, just go ahead and write the word brokers. You'll have to use a broker to buy the stocks. Now, you might have an electronic trading account like an E-Trade or something like that, or a T. Rowe Price, a Vanguard account, whatever, that does a lot of your digital trading electronically. But somebody is brokering the transaction somewhere on the planet, is the middleman, a broker for that. So a lot of times there's some brokerage fees tied into that. So be aware of that. And then maybe this is probably the second most important point, number 4. Number 4, the common person makes 7%. The studies that have been done on the people that put their money into single stocks, the common person makes a 7% rate of return. Barely gets past taxes and inflation, okay? It's not good. Can you make more? Oh yeah. Okay, I don't want to fool you, BS you, mess with you, or anything like that. Absolutely. There are people out there that get absolutely filthy rich off of stocks. Can you lose more? Absolutely. There are many, 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 many more tales of the people that hit it rich. There are many more tales of the people that have lost money, okay, and maybe even lost significant money. All right. So the odds are not in your favor when you do single stocks. Okay. Let's transition over to this side. I'm going to need 3, 6, 8. Holy cow. Write small over here. 1 and a 2, 3, 4, 5, 6, 7. Is that right? 1, 2, 3, 4, 5, 6, 7, 8. I got 8 points to make on mutual funds. Let's talk about them. Okay, characteristics that are unique kind of to mutual funds. Number 1, go ahead and write 90 to 200 companies or more with an up arrow. Okay, 90 to 200 companies or more. When you buy into a mutual fund, you're buying anywhere a mutual fund that invests in 90, 100, 150, 200 companies, 500 companies, 800 companies, 1,200 companies. They're buying stock in hundreds of companies. Okay, that's not a statement you can make about buying a single stock. Okay, 90 to 200 companies. The second point, right? Diversification lowers risk. Diversification lowers risk. Why do we like mutual funds? If your money is spread out in hundreds of different places, you are ultra diversified. When you are spread out and diversified, you've lowered your risk. Think about it. If your money's in 800 different companies, yeah, maybe 20, 25, 50 of them aren't going to do well, but you'll have 750 other things that are hitting for you. You are spread out. You are diversified. You have lowered your risk. Okay. Number 3, go ahead and write investors pool their money. I threw a $sign in there. For number 3, investors pool their money. Remember, I put money that I got, I throw it into the pool. If you're in the same mutual funds as I am, you throw whatever you throw into the pool. And if there's some big, rich millionaire, billionaire throwing in big time money in there, they're throwing their big time money. It's all in the pool. And investors pool their money together. And we buy investments that we otherwise maybe couldn't get into by ourselves. Okay? Like do some damage with like an Amazon stock that's very expensive to buy shares of. But together, when there's billions of dollars thrown into the pool, we can buy some Amazon stock together. And when Amazon does well, we can share the winnings with that. Okay? So investors all pool their money together. All right, number 4, professional portfolio managers manage the pool. Okay, so the next one, number 4, is, I know it's hard to read, professional portfolio managers manage the pool. I mean, there's billions of dollars in this pool. And remember, there's a dude, Andrew Sleeman, from that assignment. And Andrew Sleeman's got a team of people, smart people, we hope, that are going to take our billions of dollars there in the pool and buy good stuff with it. And some of the stuff isn't always going to be good. So it's their job to take out the stuff that's kind of sucking, sell it off before it keeps sucking even more, and put other stuff in that we think is going to do better. That's up to the portfolio manager. You don't have to freak out and watch Under Armour stock and go, oh my God, Under Armour's down today. What do I do? It's not on you. Breathe, relax, live your life, work, play, travel, enjoy your family, watch TV. Let this dude or this team of people do their job. They manage it. If you're over here, it's all on you. It's your money doing stuff, good or bad. Okay? Let them, these very smart people that went to school with it, let them make the decisions on what goes into the mutual fund. Okay? Next one, number 5, many types of investments. Okay, so number 5, right, many types of investments. There are bond mutual funds, bond funds. There are international stock mutual funds that invest in foreign companies. There are domestic stock mutual funds that only invest in American companies. There are diversified mutual funds that might have some bonds, that might have some American companies, that might have some foreign companies, that might have some cash and reserves. I mean, there's all different types of investments. It doesn't mean that all 500 things that they're invested in are stocks of companies. There's all different types of blends of mutual funds that you can get into. So there's a lot of different types of investments that can be built into a single mutual fund, which it takes your diversification to another level, okay? Here's a cool stat for number 6. 97% of 5-year periods made money. Sorry, I'm gonna do $sign again. So for number 6, 97% of 5-year periods have made a positive rate of return. Okay, let me explain this. This is how mutual funds are constructed. They are built and actively managed to make you money over time. Okay, you don't buy a mutual fund today and sell it a month later and expect to make money. You might, but they're not built that way. Sometimes when the market's down, it's up to the team and the manager to do stuff to build a rate of return on this. So 97% of the 5-year periods in the stock market, mutual funds have made a positive rate of return. What that means is you can pick any 5-year window you want, okay? 2000, 2005, 1980 to 1985, 2010 to 2015, 2015, 2020, 2000, let's get out of 2000s, 1955 to 1960. All right, pick any of those 5-year periods and all of them. In 97% of those 5-year chunks, mutual funds have made a positive rate of return. Okay, that's pretty impressive. Why? Because your money's not all put into one place, 2 places, 5 places. And these guys work. It's what their job is to do is, oh, this one's not working, let's sell this. This one's killing it. Oh, we got so much money in oil, and oil's terrible right now. Let's sell some of this oil stuff off and put our money in something that's doing well right now, medical technology or something like that. These perform very, very well when you give them time, okay? That's why this is a process over time. This is not a get-rich-quick overnight kind of class. Next one, number 7. Check this out. 100% of 10-year periods made money. Same thing as the one above, except stretch it over a decade. And you look at any decade, 80s to 90s, 90s to 2000s, 70s to 80s, 50s to 60s, 1955 to 1965, 2005 to 2015, 100%. Made a positive rate of return. Now that may mean 2%, 5%, or something like that. But what you can see is these are very safe investments that earn over time, just by the way they're built and the way they're managed. Okay, you can see these are for, we're playing for keeps here. Okay, that's how these things are built. They're amazing for long-term investing, which is what we're talking about. Okay, I'm sorry. I'm not making you a millionaire by the time you're 23. All right? That's not the class. That's not the investment strategy. That's not realistic, okay, for most Americans and most of you in my class. But the average person that does this, the average person that does this class, this system, 17 years. That ain't bad. That ain't bad at all, okay? Some of you guys can be a millionaire by the time you're 35 years old. And that's the average. Some people do it quicker. All right. Last one. Not hard to find 12%. Not hard to find a mutual fund that earns a 12% rate of return over a 5, a 10, a 15-year history. Okay. I showed you guys last week, I think it was, I jumped on Morningstar and I just clicked through 150 within 2 minutes. Okay, it's not hard to find mutual funds make 12% rate of return. And if you find a mutual fund that earns anything around double digits, 10, 11, or 12, you're going to be golden. Okay, you're going to be great. You're going to be fine. Okay, it's not hard to find those. All right, so here's what I'm going to have you guys do. In the middle is the stuff in a Venn diagram, which is why it's a Venn diagram, things that are similar. So let's do 4 in the middle, all right? And let's address these 4 things where they have some similar characteristics, all right? The first one, publicly traded companies, okay? You buy shares of single stock in Amazon, American Airlines, Disney, Walmart, Johnson & Johnson, Google, whatever. You're buying shares in publicly traded companies, okay? Like all those I mentioned. You're buying mutual funds. They're 90, 200, 800, 500, 1,200 companies. They're publicly traded companies. Both similar kinds of things. Number 2, I mean, this is kind of dumb. Sorry that I'm having you put this down, but they're investments. I think we know that by now. I hope we know that by now. Stocks are an investment. Mutual funds are a type of investment. Sorry, that one's kind of weak. All right. This one's better. We'll strengthen it up. Number 3, they earn profits or dividends when the company does well. Okay. They both earn profits or dividends when the company does well. All right. If Amazon kills it this quarter, and they make $1 billion profit, they may choose to take some of that billion or all of that billion and share it with the shareholders. Here's some profits, enjoy, and you'll get your little portion of the profits. It may be $50, it may be $500, maybe $5,000, depending on how many shares you own. It's all proportional. Same thing with mutual funds. If you're in 500 companies, a mutual fund invests in 500 companies, when they pay dividends, profits, you get a portion of all of them 500 companies that are killing it, and they'll dump money in your account. Those are called dividends. Dividends are good. Dividends are when the company does well, they share the profits with you. That is one way you make money with both stocks and with mutual funds. And then the last one is they're both traded in shares. They're both traded in shares. You buy shares of stock, you buy shares of a mutual fund. And yes, you can buy parts of shares. I mean, if you have $1,000 to invest and the stock price is $50.52 when you buy it, you're going to get fractions of shares, and that's typical. That's normal. You can buy fractions of shares. It's not a perfect science where I have to buy exactly 50 shares or exactly 22 shares, or you'll get fractions of shares. And same thing with mutual funds. They're bought and sold in shares. $52.12 a share, $252.17 a share. They're both bought and sold in shares. Okay. So here's what I'm going to have you guys do. Here's where we're at. This will be your assignment today. All right, we've done the notes together. So I want to see this turned in, and I'm going to have these two questions underneath. Up to you. All right, you guys give your own opinions on these. I won't mark it right or wrong if you choose stocks. Don't choose stocks. But if you do, I'm not going to mark it wrong. Please don't choose stocks. All this stuff says don't choose stocks. But whatever, and I'll have you answer these two on your own. However you want to do this, if you don't have a printer, draw me 2 circles and write the notes in, and then just do the 2 questions on the notebook piece of paper underneath, snap a picture of it, upload it to the Skyward Learning Center. If you had printed it out, cool. Scan it, whatever, take a picture of it. I don't care if you hand draw it, it's totally cool. I'll make this due tomorrow, April 22nd by 9 a.m. We always do. It's our typical turn-in deadlines on that. So I want this all filled out, our notes, and I want you to answer question 1 and 2 on your own. Okay? Hope everybody has a wonderful day, and I will see you guys tomorrow.